Welcome back to the Talking Hedge. I'm Josh Kincaid, and this is your Cannabis Business Podcast. This is a brand new segment. With us is Rohit Srivastava. He's the Chief Investment Officer and Portfolio Manager for Saroj and Bhanu Fund, and has put together a portfolio index for us with cannabis stocks with an artificial intelligence-based algorithm that has some predictive analytics. I'm going to let him dive right into this opportunity. We're going to have once a week repeat here where we kind of give you, for entertainment purposes only, a look into what might happen next week into the cannabis stock market. So with that, Rohit, take it away.
Well, thank you, Josh.
Let's dive right in. There's a couple of indexes out there already. The ETFMG Alternative Harvest Index, ticker symbol MJ, had a huge tear the first quarter of 2019, up almost 50%. I think it got to 46% or more, and then has crashed. And so there's been a lot of interest in individual equities and overall portfolios or ETFs. And so I've asked you to put together some stock. Looks like you grabbed maybe 19 companies to throw together in an index, and I'd love to see kind of what you've done.
Sure. So these 19 companies were pulled based on different aspects, not just entertainment-based marijuana stocks, but entertainment-based or medical purposes or testing tools, technologies which will help this industry to grow. So there were different companies, and these 19 ones are that basically I picked. And you can see the performance this year based on, like you were saying, that some of them perform and excel, some of them are really terrible, and created an index based on equally weighted investments. Like if I put $1 in each of these stocks, $100 in each of the stocks, how would these index perform overall? So based on, like I said, like if you put $100 in each of these stocks and investments, and how would these perform over a period of time? So taking this like last 3 years as a starting point, that last 3 years, how this index has performed. And like you can see,
is this a regressive analysis that we're looking at over the last 2.5 years?
Yeah, like over the last 2-ish years, 2 to 3 years. And what basically you can see that the trend has consistently been upwards. And there had been a die where in 2018, the last quarter of last year, where like the whole industry, the market was going downwards in that. This was the point of entry point. If somebody wanted to get in, the 111 was the breaking point where the stock was getting back in. That was the getting point into that. Was a re-entry point of that. And since then, the market has been doing good. But like I said, when you're talking about trades, you basically still have to manage your investment. You still have to manage your when to get in, when to get out aspect of that. And remember, this is an equally weighted investment. This is not where you are trying to weigh the company based on how much net revenue they get, net profit they get. This is not based on that, which most of the indexes do. So if you would have got in there, and probably the getting point of that was somewhere at the mid of July, that would have been the getting out of that. So you can see that the trend is completely in the upward direction. However, since mid of July, there has been like a massive sell. Like you can see, there has been massive sell where the index broke down and could fall further down than that. And it even broke the mini trend it was trying to create. It even broke that trend. So what my analysis tells that it will keep falling, and it'll probably this index will probably fall till a support line of $4.75, which would be the net index value at this point of the stock. If not, then we might have to wait for the next trend to start to get into this point.
What's the process of getting in and getting out? Do you have like a trailing stop loss when it's going down like it is right now, or are you playing that on the way down with options?
So most of them are trailing stop loss. And there are multiple ways of getting in and getting out of this in this particular market. And in this particular algorithm, one way of getting it is anytime it breaks the trend line, that's when you got to get out. And anytime it gets into a trend line, that's when you get in. So there's one approach of that. The second approach is you can have a trailing stop loss, which I prefer a trailing stop loss of like about 10% in this volatile market of the index itself. So the trailing stop loss of 10 market. But if you take the first approach, which is the very simplistic approach that anytime it breaks the trend line, you sell, and anytime it gets in the it gets into the trend line, that's when you get in. Even with that approach, in 2 years, you'll still be seeing like about 200% growth. So this was completely price based. But if we take this next approach, which is more volatility based, and volatility in the sense like how much money. So this is a homegrown investment model, which completely AI using AI tools. And what this basically analyzes, it analyzes how much.
One sec, I'm sorry to interrupt you, but is this a combination of an RSI, or relative strength index, and some other things that you've seen in the past, or what did you do to throw this together to make this your own indicator?
So this uses the how much of cash in and cash out that's happening. So this does not uses any RSI and MACD or stochastics or any moving averages. This is not.
But it is a money flow indicator.
That's right, it's a money flow indicator. And what it really does, it identifies how much cash in people are putting in and how much cash out they're doing. So what it really means is that people are putting cash in all the time. But there is a trend that happens, and the blue line which you're seeing is the actual cash in and cash flow of this index, and it takes a 15-day moving average of that. And the red line is the average daily trade value of per stock. So on an average, 95 million, 93 or 100 to 90, 100 million of investment is done every day in this 19 stocks. That's what it really means. And so like you can see that, the entry point in the previous slide, we saw that 111 was the entry point. And that's where a bunch of cash flew into these 19 stocks. And it will keep going up and down. That's the nature of this industry, that it's completely very volatile. It will keep going up. But the general idea about this uses completely AI tools of understanding what the behavior of the stock is, what the predictiveness of where basically it's going. So from that point of view, what really saying is that overall in the last 8 months, the trend of how much money is coming in and coming out is going downwards. Really means that people are pulling money out of this. People are pulling.
Can you infer from the data if there's a movement in the market? To make an analogy, I worked for a company that would aggregate trades. If you wanted $5 of Berkshire Hathaway that was trading at $180,000 per share, you could do that. And so we were a broker dealer. We were allowed to aggregate trades and then go out on the market one day a week and buy hundreds of thousands of dollars, if not millions, 20 million at times, and buy and move the market. What I'm seeing is on the first of the month in February of 2019, the market kind of starts to plummet, and then you see March, and again in April. You look at May, look at that plummet. July 1st. Is there a chance, and I know I'm asking you to infer, and it's probably the worst question to ask someone like yourself, do you think that it's possible someone's moving the market on these specific days? There's a repeat pattern here.
It could be possible that people are just trying to move the market, but it's also possible that we had an extremely good run in the last couple of years in this stock from the time this has opened up in a couple of states, and there was a lot of money pumped in. So when I look at the first year of the market, it was all pumped in. But over a period of time, I feel that one of the two things is either there is a pull out of the money from that, or it is an indicator that a slow buying is happening over a period of time. A slow buying is happening. The pumping happens. People put in money in there, and they dump it. They're still taking out the profit, but they're slowly buying at a lower price. That's what probably might be happening. But like I said, if you look at this H2, But if you look at the H2, that's where the pattern is changing. You can see that there is a completely downtrend. But in H2, that's where the pattern is changing. It doesn't say anything that, you know what, this is the point to get in, because the whole matrix about this indicator is that as soon as the money pumped in goes over the average daily trade value per equity, that's where that's where the opportunity lies in getting in. That's where the opportunity lies, that there are a bunch of people trying to pump in money into this.
And I'm no chartist, but I can tell that August 2nd, there's definitely a change in the trend.
Right, and you're correct. That's a change in the trend, and until it is still a point where it needs to be hold. It needs to be on hold. And like I said, that, you know, unless the behavior doesn't change, and the pump in money or the cash in cash out value of the 15-day moving average does not process the daily trade per value equity per equity, the market is still at risk. I would say still at hold. People who want to get into this trade, they should still be holding on those things, on those trades. That's what I would say at this point where it is.
So what's going to happen next week?
So this is what from what I like I said, like from what my thought process around this is, if I want to get into this market, I would probably wait till for maybe like 1 or 2 weeks, and in 1 or 2 weeks, what it looks like it's trying to create a new trend, and the new trend is kind of trying to move upwards at this point. That's what I think. But regardless, I think the point to get in is after it crosses this red line, which probably it looks like it might bounce back, and that probably in maybe end of August, end of September is probably the point where probably it might turn around. That's what that's what from a predictive point of view, that's what probably it looks like. But if it doesn't, then if it falls below this point, which you're saying it falls below this point, then this was more like a fakely created matrix for pumping out some more money. But I think in the next 2 weeks, 2 to 3 weeks, I think it is mostly on a hold pattern and waiting to bounce back from.
Now, you should also see some asset reallocation, a lot of portfolios this time of year when people, you say sell in May and go away. Now that they're coming back, they're going to look at some of the high returns that they got, probably sell those and look for some more value securities. So there's definitely going to be some shuffling around for the next couple of weeks. Absolutely. And that's just normal in the industry. It doesn't really have anything to do with this.
That's correct.
Interesting. I guess we're going to have to come back to the Talking Hedge next week and find out.
Sure. That sounds awesome.
So with that, we're going to roll this one up. I'm Josh Kincaid. This is Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out.